benchmarking your company against your peers. This is a lengthy webinar, so thanks for hanging in with us. We've got a little bit of time left, so I'll go through this section fairly quickly, but it is important because it's the big number, right? What is your company worth? So we'll spend a little bit of time on it, but we want to leave some time for questions. So I'm going to spend some time on this slide, and then I'll go quickly through the rest. And so I'm going to start here, which is, so this section's on valuation, like what your company is worth and how to have, so a good starting place when you go fundraise is you should have a pretty good idea of what your company's worth before you go negotiate, right? You'll get to a yes and a combined yes and a good outcome together if you're both starting from a pretty close place. If your expectation is 100x ARR and the market's nowhere near that, right, you're going to have a hard time and it's going to be a weird conversation with investors. Similarly, like you might be leaving money on the table if you think your company's worth 2x and actually the market's more like 8x, right? So first and foremost, SaaS companies are valued as a multiple of ARR. That's been pretty common for a long time, but just want to share that. So when I talk about 8x, I'm talking about 8 times annual revenue, and it's typically run rate revenue. This is a data base of public SaaS companies that we track. It's called the SaaS Capital Index. It's 65 or 67 public SaaS companies that roughly fit the types of companies that we work with. Obviously, they're public, but it's the right sort of type of company characteristics, and we track them because we want to know how much they're worth in real time, and then we can compare that to our portfolio and help with our portfolio understand how much they're worth. And so this is the right starting place. You want to start with public companies, and then you can we'll talk about ways to discount that down to a private valuation. Private companies, just because they're illiquid, they're smaller, tend to be worth less than public companies. So on the left here, we've got companies by revenues. The bubbles are revenue size. So Salesforce is that huge one, still growing at 25%, pretty amazing. And then growth rates on the x-axis. And so you can see by that R squared, 60% of a valuation multiple is driven off of growth rate in the public markets. So growth rate is sort of king, and that's one of the benchmarks we'll talk about. Retention is also extremely important. So that's the other one I've got data on that I'll show you. And then there's a litany of everything else that we've talked about. Burn rate, target market, all that stuff is important, but growth rate is 60%. So start there. Current public markets are extremely elevated, as you all are probably aware. The median public SaaS company is trading at 16 times ARR. Historically, when it was more sort of 6 to 8 times, private companies were trading around 20%, 28% less than that, sort of in the 4 to 5 times range. We have seen private valuations come up, but not nearly to the same degree. And so doing some analysis on valuation events that we've been privy to, it looks like the discount's around 50%. So it's up. Private companies are trading around 8 times on median. So that's the important place. We're starting from median, and then we'll look at the benchmarks in a second, so you know whether you're above the median or below, right? So you can understand, should I be worth 10x or should I be worth 6x? So that's sort of the framework, and that's the starting place. This is some data from our survey. We do a survey every year. Something like 1,600 private SaaS companies respond, and I won't go into all this data, but all of this stuff actually is on our website. So all this valuation stuff, there's a white paper that walks through the whole framework that you should check out if you haven't had experience valuing your business before. And then we have individual reports on all this growth rate and all these other metrics and things from the survey to help you generate a good sense of where you stack up to your peers. So I won't go into too much detail, but these are the medians and the average growth rates by ARR bucket. And so this is the starting place. So if you're a 35% growth rate company with 5 million of ARR, that alone, without looking at anything else, 8 times ARR is a good starting place. If you're growing at 100%, you're probably worth a premium to that 8 times, right? You might be worth 10x or 12x or even 14x. If you're growing at 5% a year, a discount to that 8 times. Similar on retention, again, you can go spend lots of time in the data and the reports on our website, but know where you stack up to your peers. One data point I'll share with you on this slide that's really cool is we've seen this year over year, is retention tends to go down as a company grows. We think of companies improving their retention as they grow, but actually, at least on the gross perspective, we think this is because just simply customers haven't had a chance to churn out yet. And so, but over time, as you grow, you kind of find out what your true base rate retention really is, and it's a little bit over elevated early on because you just haven't had a lot of renewal opportunities. So that's one interesting trend here. But then go find yourself, figure out where you are to your peers, and then that'll help guide your your valuation expectations. I'm not going to go into this slide. This is the other things that are important that we mentioned that go into a valuation calculation. Again, you can go check out the white paper. I went through that quick, but wanted to leave a little bit of time for questions if we have.